Thank you for joining us for another edition of Jake's Super Safe Money Updates. Jake, I think the question on everyone's mind is, what does all this crazy stock market volatility mean?
Well, this graph that you're looking at is the last month in the stock market and the Dow Jones Industrial Average, and it indeed has been a wild roller coaster ride. But I think everyone in the market world knows that you're not supposed to be worrying about these short-term aberrations. However, what that's asking people to do is take their emotion out of investing, which is very, very difficult, and it's one of the reasons that most people lose money in the stock market because they let their emotions help them make decisions. What we're going to look at today is just a brief history of the long-term averages and show you the true important things that you should be looking for. So what we're going to look at is the long-term Dow Industrial Average numbers from 1900 to today. What you'll notice is that long-term graph was very flat for many, many years, and then we had that large run-up, which was the 80 to 2000 stock market run-up, and then we got into the recent spate of sideways volatility. What I'm going to do is change this scale just a little bit to show you the volatility that was going on the last 112 years. What you'll notice here is that the amount of sideways market periods are very long. So if you look at the early 1900s, you've got 5 and 18 years sideways for a total of 23. And then after the Great Depression, from 29 to 54, we had 26 years. And then from 66 to 82, we had 16 years. And then now we're in another sideways market, what they call a secular bear market or a long-term bear market. So what's important here is it doesn't matter what happened last month. It also doesn't matter what happened the last 112 years. What's more important is where are we in these medium-term cycles, because that's what's going to define our retirement cycle. So if you look at it, we're in a 12-year sideways period, but the last several sideways periods were 16 to 26 years long. So what that tells us is that we are in the middle of a cycle that could last several more years, and you need to plan appropriately. What we do at our firm is try to find you those vehicles that help you grow your money with a safety net in case we do have some more downside in this long-term corrective phase. So the market's getting very volatile. As we talked last week, this might be an inflection point where we see another correction, but at the end of the day, we don't have a crystal ball, but we can look at history and say these periods last longer than most people are prepared for.
So what should the everyday investor do in light of this data?
Well, it's easy to say and harder to do, but you have to take emotion out of investing. So if you're going to be in the stock market directly, or the bond market for that matter, there's a lot of risk there as well. You need to be able to stomach the ups and downs and have the correct amount of money in there, realizing that if you're in retirement, your goals need to shift a little bit more to safer assets. Don't look at the short term. Look at where we are in the medium term phase of the market. And as we said here, we've got another 4 to 14 years by history that we could go along this way. So you've got to figure out what kind of risk you can take and then try to find the vehicles that will get you through that with the proper amount of risk in your portfolio.
Thank you, Jake.
You're welcome.
For those of you listening in today, please feel free to contact us if you have any further questions.